Hi, I'm Richard McGregor from the Financial Times, talking to the Democratic Senator from Ohio, Sherrod Brown, about his bipartisan but controversial bill to force the banks to take on much greater capital. Senator, in the wash-up of the introduction of your bill, the publication of your bill, what's been the reaction? You said thought you had 40 votes in the Senate when it came out. Do you still think you've got 40 votes?
I think we have at least 40. The reaction has been interesting. First, from the Senate, we're talking to 8 or 9 or 10 Republican offices who showed little interest a year ago and now are showing much greater interest. We're seeing conservative columnists George Will, Peggy Noonan, more progressive columnists too. No surprise there, perhaps, on this, and a bunch of people who are long-term experts, respected in the financial community. People like Sheila Bair and people like Tom Honig and Dan Torello and others who really do understand that this is a serious problem. The other thing is the Senate went on record on a 99-0 vote during the budget debate, acknowledging, one, that too big to fail still exists, and two, that we should do something about it. Too big to fail in the sense that banks, the largest 6 banks, clearly get a 70, 80, 90 basis point advantage when they go in the capital markets. Bloomberg has reported, as estimated, at $83 billion advantage. They get subsidy, if you will, implicitly from taxpayers every single year because the markets think these 6 largest banks are too big to fail. So that's why we're seeing this continued building of support for this legislation.
Where does that building leave you politically? I mean, of course, the Dodd-Frank regulations are still being written, only a third of them now. Are you really effectively positioned yourself behind Dodd-Frank and you'll be an alternative way of handling this issue only if there's another crisis?
No, I think that I hope this builds some momentum for the Dodd-Frank rules. One of the chief banking lobbyists in this town, Wall Street lobbyist, said after Dodd-Frank passed, now it's halftime, meaning that now the tens of millions of dollars are going to go into lobbying the agencies to slow the rules down, to weaken the rules, to dilute the rules, and that clearly has been happening. That's why our legislation can give some more impetus and buck up, if you will, some of the regulators here that are going through this process. Additionally, I think that this legislation is standing by itself, is helping to educate my colleagues that this is still a problem. These banks still get an advantage. 18 years ago, the largest 6 banks in this country, their combined assets were 18% of GDP 18 years ago. Today, they're over 60% of GDP. That means the banks are not just more powerful economically, but more powerful politically, as you can see watching the unfolding of this bill and especially the rules on Dodd-Frank.
The banking industry says the bill's capital requirements have no rational basis and fail to account for the different kinds of risks that different assets have in the system. In short, they say the bill will cap bank lending and effectively cut US economic growth.
The evidence is that none of those things are really true, what they claim, that actually bank lending has been down from some of these large banks that have lower capital standards. And it's as if someone goes to Citibank or goes to JP Morgan Chase, they don't get a loan, they don't try elsewhere. They don't try the Huntington in Ohio. They don't try Community Bank in Sycamore or Coldwater, Ohio. So there's no real evidence for what they claim in this. But I understand their opposition because they need to build more equity capital, because they may need to retain earnings and use that for capital, that it might mean less money for shareholders, but it makes society wealthier. I mean, this is good for our country. Some bank shareholders may make a little less money, but these capital requirements mean the system's going to be more stable, and we won't have these kinds of built-in advantages that the largest 6 banks clearly have now.